Warm welcome to each one of you on this session of technical analysis. And we are going to take up market indicators properly today. What are market indicators? So, market indicators are tools to gauge an entire market and not just the individual share. So, they add significant depth to the technical analysis as they contain much more information than price and volume. A typical approach is to use the market indicators to determine the overall trend of the market, to understand where the overall market is heading towards, and to use both the price and volume indicators to determine when to buy or sell an individual share. A very simple market indicator is that of moving average. So the moving average, the simplest form of moving average, is referred to as the simple moving average. So moving averages, they are usually calculated to identify the trend direction of a stock or to determine its support and resistance levels. The most common time periods can be 15 days moving average or a 50 days moving average or a 200 days moving average. It can be for a shorter duration. It can also be for a longer duration. So a shorter duration is more fitted for the traders, whereas a longer time moving average, say 150 or 200 days moving average, is more suited for the investors. So the longer the time span, the less sensitive the average will be. Investors, they may choose any varying lengths depending upon their trading activities. So the moving average, they reflects the overall trend in the market. And so if the markets are moving high, right, it is very much reflected through the moving average and so on and so forth, which means a rising moving average indicates whether it is a 200-day, as you can see, I've taken a 200-day moving average or a 21-day moving average. So if it is a 200-day moving average or a 21-day moving average, which is rising, which is moving up, it indicates that the security is in an uptrend, while a declining moving average, as you can see, 200 days also declining, 21-day moving average is also declining. It indicates that it is a downward trend. An upward trend is confirmed with a bullish crossover which occurs when a short-term moving average crosses above a long-term moving average. As you can see over here, a 21-day moving average is crossing over a 200-day moving average. So this is indicative of a bullish trend. Whereas a downward trend or a downward momentum is confirmed when a bearish crossover takes place. So a bearish crossover occurs when a short-term moving average, in this case a 21-day moving average, crosses below the longer-term moving average. It crosses below the longer-term moving average. That is the time we understand that the bearish trend has set in. Moving averages are again a very important tool to either buy or to sell. So the basis of interpretation is to buy when the share price moves above its moving average. So in this case, as you can see, both in case of a 21-day moving average or in case of a 200 period moving average, you see that the prices of the concerned stock, they are moving above, or they are moving over and above the 21-day and as well as the 200-day moving average. So this is indicative of a buy signal. Okay. Whereas in case of a situation wherein the prices are moving below the shorter period moving average, which is 21 days, or a longer period moving average, which is 200 period moving average, it is indicated that it's time for the trader to actually sell. So a trader may wish to buy when the price is above or close to 200-day moving average. And in this way, the longer term moving average acts as a filter, helping the trader to only trade in the overall trend direction. So buy once when the share prices are over and above the moving averages, and sell once when the share prices are below the moving averages. The moving averages, another version of moving average is the exponential moving average. Another version of moving average is over and above the simple moving average is the exponential moving average. And why it is referred to as exponential? Because here more weightage is given to the recent prices. So as more weightage is given to the recent prices, it is reflective of more newer information entering into the market. And in this case, as you can see, the exponential moving average is reflected by a green line, and the red line is indicative of a simple moving average. So as you can see in this case, the exponential moving average moved sharply lower than as you can see, the exponential moving average, it moved sharply lower than the simple moving average. Okay, and the moment the EMA is sharply moving lower as compared to the simple moving average, it is for sure that from here on the market is going to move downwards. And that is what we see, that the market is moving down. So you see the movement of the simple moving average, and you see the movement in the exponential moving average. So the exponential moving average, the move is very sharp, and since it is moving down, it is indicative of a bearish trend. Whereas if you go towards this side, you find that the exponential moving average turned up. Okay, so the moment it is turning up, see, it was moving below, but from this point it turned up. So the moment it is turning up, it is an indication that from here on the market is likely to go upwards. Okay, and the moment it is, the exponential moving average is well ahead the simple moving average. Okay, it is sure shot an indication of the fact that from here on the market is going to move upwards. Moving averages, you see in this case, again reflects the same kind of a sentiment. Okay, so the moment the moving average is coming down, as you can see, it is in this case shown by a pink dotted line. So the moment the exponential moving average is coming down, look at the trend. The price is also below. The price is also coming down. So the moment there is a downward trend in the EMA, or the EMA is turning down, it is indicative that from here on the market trend is going to be bearish. The market trend is also going to decline. In this case, as you can see, that from here on the exponential moving average, it is moving up. So the moment it is moving up, okay, it is indicative of the fact that from here on the prices are going to move up, and that is what we witness. Okay, and from here on we see that since the exponential moving average is rising, so does the concerned stock price, which is also rising. So moving averages, they also showcase the support, and they also show the resistance. So as in this case, you can see the support which is being reflected by the moving averages, and the resistance which is shown by the moving averages in this case. So the moving averages, as you can see in this case, the chart above shows the New York Composite with a 200-day simple moving average from mid 2004 until the end of 2008, as you can see over here. So the 200-day provided support numerous times during the advance, showing that the prices will not fall below this. As you can see, the prices will not fall below this. Okay? And over here, as you can see, once the trend reversed with a double top, as you can see, with a double top support break, the 200 moving average, it acted as a resistance, and from the around 9,500. So it was acting as a resistance, and the moment you see that the prices and the simple moving average is somewhat crossing over each other, that is the time once when the resistance is hit. And the moment the resistance is hit, we find that from there on, the prices is actually coming, which means what? People are selling off their shares. And the moment there is a huge selling pressure, the prices ultimately is coming. So the moving average also reflects the support and the resistance. So limitations of moving average. So though we have seen that the moving average reflects a lot of information, or when to buy, when to sell, or the support and resistance of the overall trend of the market, but at the same time it is having certain limitations. What are the limitations? Moving average is calculated on historical prices, and since it is calculated on the historical prices, it may not provide predictive insights in terms of where the price is going to go next. And that is why the moving averages is also referred to as the lagging indicator, meaning it follows prices. So the next indicator which we are going to take is the MACD, which is moving average convergence divergence. So as you can see over here, we are seeing a MACD line. We are seeing an MACD line in this particular case. Okay. So MACD, how we arrive at this particular line? The MACD is calculated by subtracting a 26-day moving average of a security's price from a 12-day moving average of its price. And the result is an indicator that oscillates above and below zero. So you see that this is a zero line over here. This is a zero line. The MACD is oscillates below this zero line. And there is this signal line which you can see over here. So a signal line is representative of a 9-day moving average of the MACD, which is usually plotted on the top of the MACD indicator. Now, how MACD is used for decision making? So usually, if the MACD, if it falls below the zero line, as you can see, if the MACD is falling below the zero line, it means that a bearish trend is settling in. So the moment the MACD is falling below the zero line, it indicates that a bearish trend is settling in. Here you see this is the zero line. MACD is below the zero line over here. So you can see that from here on, the bearish trend is settling in. And as the MACD is increasing, okay, and it is also over and above the signal line, okay, it is also over and above. Now just see, it is, in this case, it is over and above the zero line. So as it is rising above the signal line, it is indicated that from here on the market is going to be bullish. And this is the right time. So as it is rising, this is the right time to buy over and make good amount of profits. And as it is falling, as we see it is falling, it is indicative that a bearish trend will follow. And if the bearish trend will follow, that is the time when we should understand that it is the right time to sell and get out of the market. As you can see over here, I think this is you will be able to understand better from this particular MACD chart. So MACD crossing above 0 is considered bullish. So this is the 0 line. Okay, MACD crossing above 0 indicates the bullish trend. Crossing above 0 indicating bullish trend. Okay, and the moment MACD line crosses below above the signal line or below the zero line, it is indicative of a bearish trend. So you see, MACD is falling below the zero line. This is the zero line. MACD is falling below the zero line. See, the market is moving. The market is moving downwards in this particular case. So MACD, as it is going over and above the signal line, okay, and it is also above the zero line, it indicates that it is a time to buy. And if the MACD is falling below the signal line, as over here, if the MACD is falling below the signal line, okay, it is also falling below the zero line, then it is indicative of selling or taking a short position in the market and thereby to come out from the market. So MACD line crossing above the signal line, it indicates, okay, that one should buy. And when the MACD line crosses below the signal line, it is indicated, it is crossing below the signal line. The trader should understand that this is a time to sell. So what is the limitation of MACD? So MACD indicator is again considered to be working best in case of a changing market. So if the market is consolidating, the market is kind of range bound, in that case MACD doesn't work that well. So next trend which we are going to take up is the next market indicator which we are going to take up is the relative strength index, commonly known as RSI. RSI is a momentum indicator. So unlike the moving averages, whether it is simple moving average or the exponential moving average, RSI is a leading indicator, whereas your moving average is a lagging indicator. So RSI is a leading indicator, it's a leading momentum indicator which helps in identifying a trend reversal. The RSI oscillates between 0 and 100. Okay, so the objective of using RSI is to help the trader identify the trend and to identify where it is oversold and the overbought price areas. So when the prices they move up very rapidly, as we can see in this case, once when the prices are moving very rapidly, at some point it implies that that particular stock or asset is overbought. Okay? And if it is overbought, it is understood that a likely correction is going to take place. So you see it's constantly moving, and after that, so it is indicative of overbought situation. And once when there is overbought, it is understood that a likely correction will take place, and you see a trend reversal is seen. The red candlesticks, they are indicating a reversal trend. So you see this is coming down. Okay. Likewise, when prices they fall rapidly, at some point it is considered to be oversold. Okay. An oversold position indicates a negative momentum, and in this case also it is indicative of a price reversal. As you can see, price is coming down, and it's coming down very heavily. So it is at this point in time you can see a reversal trend happening. Okay. So traditionally RSI readings greater than 70 level, as you can see, the RSI reading is over and above. So if it is over and above the 70 level, it indicates an overbought region. And if it is an overbought region, since the likely correction is going to take place, it is understood that it's right time to buy, it's right time to sell, it's right time to short your position. So when the RSI is over and above 70, then it indicates that it is the right time to take a short position and come out of the market, because a reversal is likely to happen. And this is what we see. The moment the prices have touched it's over and above the RSI line, is over and above the 70, okay, it's right time to sort of sell and come out of the market, because after that the prices may come. Similarly, in case of RSI indicating an oversold kind of a situation. So in this case, if you see, uh, over here the prices are falling, and so you see that the RSI is also below the 30 mark. Okay? And it is below that 30 mark, as you can see in this case. It is the best time. So you can understand that the market is oversold. Okay? And if the market is oversold, okay, it is indicative that soon a reversal trend is likely to follow. And as it has touched below the 30 mark, a reversal trend is what we witness in a longer period of time. So had we entered, so the moment it is oversold, it is indicative of the fact to enter the market, to take a long position. So here, if you had bought, looking at the RSI index over here, okay, it is indicative of an oversold region, okay, falling below 30, falling below the 30 mark. So which means that from here on, it's better to buy, take a long position. And you see, if you had bought in that particular position, that particular region, where the RSI was indicating an oversold mark, okay, see, you would have definitely made a good amount of. So once when RSI is over and above 70, it is understood that it is overbought. Okay, a resistance level might have been reached and a correction is likely to follow. Whereas in the RSI, if it is below the 30 mark, it is indicated that the market is oversold. Okay. The support level has been reached, and from here on, a trend reversal is likely to happen. And during an oversold period, once when the RSI is below 30 mark, as you can see, it's better to take a long position over here. And if you see, going ahead, we will definitely go on to make a target. Okay. However, one should be very, very careful while using the RSI, especially in case of stocks which are very, very strong. So if they are showing a very high upward movement over a period of time, you will always find that the RSI will always be showing an overbought situation, right? So a stock which is in a continuous uptrend, the RSI will remain stuck in the overbought region for a long period of time. And this is because the RSI is upper bound to 100. Now it cannot go beyond 100. So invariably a trader would be looking at shorting opportunities, but the stock on the, so it's what? It's the moment it is in the overbought region, over and above 70, or let's say over and above 80, if you are taking that 80-20 kind of a line, or 70-30 kind of a line, the stock will remain overbought for a very long period. And if it is overbought for a very long period, you might be tempted to as well sell. But maybe that the stock from there on might go further up. Okay? So if a stock is overbought for a for a long period of time, it might be possible that it continues in that state for some more time. So whenever you are taking any decisions, always see what is the kind of information which is coming into the market with reference to that particular stock. So maybe it is in the overbought region for a very long time, and you might even plan to take a short position and come out of the market because you might be expecting reversal. But it may be possible that for stocks which are very strong, fundamentally which are very strong, it might move higher than that, and then you might repent. So a word of caution over here is that if a particular stock is overbought for a very, very long period of time, it may be taken as it's going to remain in that region for a considerable period of time. Okay? And a good example of this is Eicher Motors. Way back, if you see Eicher Motors between, let's say, 2012 to 2016, if you see the kind of movement which it had. So it was in that overbought region for a very, very long period of time. Another scenario is that of oversold. So a stock which is in a continuous downtrend, the RSI will be stuck in the oversold region since the RSI is having its lower bound is 0, so it cannot move below 0. In this case, as well as the trader may be looking for a buying position, okay, but the stock will be going even lower and lower than that. Okay, so maybe you bought by looking at that, you have taken a long position, bought the stock by looking at that oversold region, okay, but maybe that the stock is moving further down from there on. So it might have hit 0 and you must be thinking that, or it might have hit that oversold region of 30 and you might think that this is the best time to take a long position to buy the stock. But maybe that RSI cannot move below 0. It may be possible that you have bought it and that particular stock moves even below that level, below that particular price level. Okay, and this kind of a situation is seen in case of Suzlon Energy, wherein the stock generated a return of negative 34% year after year. So you might have maybe taken a long position by understanding that RSI is showing an oversold region and to take a long position. But if you had taken a long position, from there on, you would have only made more losses. So RSI should not be taken at only by looking at the overbought region or oversold region. Look at the fundamentals of the stock as well. Like as I said, in case of Eicher, in case of Asian Paints, or let's say in case of Suzlon, or let's say another good example maybe. So you have to take other indicators, other factors in the form of the fundamentals of the company broadly. Also factor in your decision. Yes, so we have seen that when to buy and when to sell. So this is the time when you will be selling as far as you are looking at the RSI indicator. So if it is overbought, if it is over and above 70, that is the time to sell because the trend reversal is likely to follow, so you make your profits and come out of the market. Whereas if it is oversold, which means it is somewhere below the 30, the RSI is falling below that 30 mark, indicating an oversold region, that is the time to enter the market. That is the time to take a long position or to buy. But yes, a word of caution, you have to see the other factors, other indicators, the fundamentals of that particular stock. So as I said, in case of Eicher or in case of Sensex now. Next indicator which we are going to take is Bollinger. So this is a very, very popular indicator, and both the professionals as well as the novice they use it for their decision making. And it tells essentially when to enter and when to exit the market. Okay, and these why we refer to them as Bollinger bands because as you can see, there are two bands which can be seen, the upper one and the lower one. The upper one and the lower one. So these bands are often used to determine the overbought and the oversold condition. So The basic interpretation of Bollinger Bands is that the prices tend to stay within the upper and the lower band. And the distinctive characteristics of Bollinger Bands is that the spacing between the bands varies with the volatility. So here, as you can see, the band width has increased. So it is indicating a very high volatile. Whereas if it is shrinking, if the band is shrinking, which means that the volatility has reduced considerably. Okay. So one way of interpreting the Bollinger Bands is to look at the volatility. So if the bandwidth, they are very wide, then it indicates that the market is very, very volatile. Whereas if the bands are coming closer, the upper and lower band, if they are coming closer, it indicates that the volatility related to that particular stock has come down considerably. So this is an important point which is being shown by the Bollinger Bands. So during periods of extreme volatility, the bands widen as we can see, and during periods of stagnant pricing, the bands are narrow. Okay? So the narrowing bands, they increase the probability of a reversal settling into the so Bollinger Bands are also used for buying and selling. So in this case, as you can see, a down arrow is a sell signal. So in this case, if you see, there is a central line, which is a 20-day simple moving average. This is the upper bound or the upper band of the Bollinger, and this is the lower band of the Bollinger. Now, although most of the signals they work in this case, so if you see broadly in this case, what happens is that once when the bands, okay, the upper arrow in this case, they are indicated for buy signal. And when are you going to buy it? Once when the prices are touching the lower band. Once when the prices of the stock or any asset, once when they are touching the lower band, it indicates that it is the time to buy. It indicates that this is the time to buy. And once when the prices are touching the upper band, it indicates that this is the time to sell. Okay. However, if you see in this particular case, what is it? So this is touching the upper band, the prices are touching the upper band, which means you should be selling it. But in this case, if you see, you can see what is happening. So if you sell it, you might have missed a further rally. So you have to be very careful once when you are trading, as far as if you are looking at the Bollinger Bands for your trading purpose, you again have to be a little bit careful. So though the buy and sell signal, they are almost 95%, they will be the right kind of direction, right signal. But there may be a situation wherein you are seeing that the prices have touched the upper band, and obviously you will be selling. But the moment you sell after that, you see that the prices are touching a newer high. And this is what is referred to as the envelope expansion. So all the most of the, you see this, the prices, they touched the higher highs, okay, and it touched the upper band. So you plan to sell it. The moment you sold, I mean, at this particular region, you must be having a sigh of relief. Why? Because immediately after that, the prices have come down. The prices have come. So the most of the time, this indicates well, okay, in terms of buying and selling. But however, there might be a drift, okay, a higher drift which might follow. So although most of the signals it worked quite well, but there is a stage when the price stuck to the upper band, as in this case, and in fact after that the price continued to drift, and therefore even the upper band expanded as well. Upper band over here, it expanded. You see this? It was this, and then you see the expansion. Okay, so the upper band expanded, and this is referred to as envelope expansion. So the Bollinger Band's upper and lower band together, they are forming kind of an envelope. And the envelope, it expands, as you can see over here, the envelope, it expands. And whenever the envelope expands, the price drifts in a particular direction, indicating a strong movement. So in these cases, the Bollinger Band signal fails when there is an envelope expansion. Okay? So you have to be a little bit careful once when you are seeing that there is an envelope expansion. That time you are required to wait for a while and see what kind of trend is following from there on. Okay, so this is about Bollinger Bands, wherein we would be selling, broadly we would be selling once when the prices are touching the upper band. Okay, and as you can see, the moment it is touching the upper band and you have sold it, you have taken a decision to short it. Immediately after that, see what is happening. And in this case, the moment the prices are touching the lower band, you bought it. Okay, and see what is happening to the prices. The prices have gone up. And the prices are well above the 20-day moving average, and giving you good profits. So this is about Bollinger Bands, okay, which is what we have seen. The next indicator which we are going to take up is the stochastic oscillator. So stochastic oscillator is again a momentum indicator using support and resistance levels. So it is again an overbought and an oversold indicator. So the stochastic indicator is broadly plotted as two lines. One is referred to as the percentage K and the other is referred to as the percentage D line. Now out of these two lines, the percentage K is appeared to be more sensitive of the two oscillators, but it is the percentage D line that carries greater weight and gives the major signals. Okay, so the ranges again, as we can see, even for stochastic oscillator, the range of these lines are between 0 to 100. And the values above 100 are considered as strong and suggest that prices are closing near their highs. Okay, and values below 20 are considered closing near their lows and are indicative of a weak kind of a market. So the images you can see over here that the images below the behavior of the stochastic within a long uptrend and a downtrend. Okay, so in both these cases, as you can see, there is an uptrend, there is a downtrend, and the moment there is an uptrend, you find that both these lines, both the percentage K and the percentage D, they are over and above, or they are higher than that. This particular broad ranges, as you can see, they have moved above this 80,000, as you can see. So the moment it's going up, as you can see, the moment it is going up, both these two lines, percentage K and percentage D line, as you can see, it is moving above this 80,000 mark. Okay? So the moment it is moving above this 80,000 mark, it is indicative of a strong momentum and of a rising trend. And if it is of a rising trend, it is the best time to sort of buy. Whereas in this case, as you come to this part of the chart, you find that both these lines, the percentage K and the percentage D line, they are moving below that 20,000 mark. They are moving below the 20,000 mark. And the moment they are moving below the 20,000 mark, it is indicative that it is the right time to exit the market. Okay, so as we can see, this is again a breakout, as you can see over here. So the stochastic signals, they give us the breakout signals, and as you can see over here that, okay, as you can see, the prices are somewhat converging, and the moment you find that there is a convergence within the prices, you see that the prices are converging, immediately you will find, and you see even the stochastic oscillator also, they are also kind of converging. So the moment you find that both these percentage K and percentage S lines, they are kind of also converging, okay, it indicates that there is a breakout which is likely to happen. So the moment you find that the prices are converging, even the oscillators, they are also converging, the moment you realize this, the moment you see this, it is understood that a breakout is likely going to, and this is what you get to see over here. The moment there is a convergence, there is a breakout. Okay. Next, it also shows the trend reversals. It shows the overbought and the oversold, which can be used as the trend following signals in while you are taking the stochastic oscillator market indicator. So the stochastic signals, they also indicate the trend reversals. So when the stochastic is changing the direction and leaves the overbought, as you can see, and leaves the overbought. So this is the overbought region over and above that 80,000 line. Okay, so it leaves that overbought and the oversold region. It can foreshadow a reversal, and that is what we get to see over here. That both the percentage K and the percentage S, they are kind of moving down, and the moment they are moving down, it is showing a reversal trend likely to. Okay, and here if you see, the moment these lines they are moving up, it is indicated that from here on, okay, an uptrend is likely to follow. So this can be said as an oversold region, and if you enter at this point in time, okay, you should be taking a long position, okay, because it is already indicating an oversold region at this point, okay. And if you take a long position, from here on, you can see that the prices are going up. So if you take a long position over here, why? Because this particular area or region is showing an oversold region. So if you take a long position in the oversold region, if you entered it, you must have made a good amount of profit. Okay, so this is how the stochastic oscillator, it reflects a kind of a trend reversal, and it also shows when to buy and when to sell. Now another, you can also find that the stochastic oscillator, they are also indicative of the trend majorly. So if you see that the prices are going up, whereas the stochastic oscillator, if that trend is, if it is showing a downward trend, you see this stochastic oscillator, it is showing a downward trend, whereas the prices of that stock is showing an upward trend. So you see a divergence. But here the divergence of the stochastic oscillator is to be seen to actually sort of find out what is going to be the trend going ahead. Okay, so you find that the stochastic oscillator is coming down, okay, whereas the prices are moving up. So this is indicative of a divergence. But which divergence? A negative divergence, because the stochastic oscillator is coming down. So in such a situation, once when the stochastic oscillator is coming down, whereas the prices are going up, it is indicative of a reversal trend settling in that price. And automatically, you will see that the prices are now coming. So whenever you get to see this kind of a situation, it's better to come out of the market, to take a short position and come out of the market, because very soon a reversal will be seen. So had you sold your price at this particular point, by looking at this negative divergence reflected by the stochastic oscillator, you would have made your good amount of profit come out of the market. Because had you waited for long, by looking at this market price movement, which is going up, whereas stochastic oscillator is going down, you would have actually, and you would have been more greedy and stayed back into the market. For sure, you would have landed up in making losses. So whenever you witness such a situation wherein the price chart is making higher top, whereas the oscillator is making a lower top, that is indicative of a price ultimately coming down. And so the moment you get to witness this, it's the right time to take a short position, come out of the market, because very soon a trend reversal will be seen and the prices are going to come down. So this is again negative divergence, which is what I was referring to. And we come to the positive divergence. So what is positive divergence, as you can see? So positive divergence, what happens is the price chart, it is making a lower bottom. You see the price chart, it is coming down. Whereas if you see the oscillator, it is going up. So again, there is a difference in terms of the kind of trend which the price is showing and which this oscillator is showing. But however, you see that there is a kind of convergence. As you see, there is a kind of a convergence between the prices of the stock and that of the stochastic oscillator. It again indicates that there is going to be a reversal. But in this case, what kind of a reversal? It's going to be a positive reversal. So whenever you get to see that the price chart is making a lower bottom, whereas the oscillator is making a higher bottom, as you can see over here, the oscillator is making a higher bottom and it is converging into each other, it ultimately indicates that the prices are going to go up. So you see this, the prices are gone up. So whenever you witness this kind of a variation between the price chart and the oscillator, it's the best time to take a long position. Because you see, just after the moment they have converged, they are likely to converge. It appears that they are converging. And if you have taken the long position, bought the stock, immediately you see that after that, the prices have gone up. So had you entered into the market at this point in time, had you taken a long position at this point in time, you would have definitely made a profit in times 2. So this is about stochastic oscillator and how it should be used for taking the decision. The last one, which you should always be considering, is the volume indicator. So always remember that volume should never be neglected because they reflect huge amounts of information. And a volume represents a transaction between a buyer and a seller. So it shows how many times the securities have been bought or sold in a given time frame. Okay. Now, to correctly interpret the volume data, it must be seen in the light of what the price is. So, a high volume, as you can see over here, there is a high volume, and at the same time, if you see, it is also coupled with a higher, with an increase in price. So, higher volume with a higher price or an increase in price, it is indicative that from there on, the market is going to go upwards. Okay, so you have to see the volume coupled with the price. So as is indicated in this particular chart, if the prices, if the volumes are going up and also the prices of that particular stock is also going up, then it indicates that the prices are going to go up much higher from there on, and that is what we get to see. The prices have gone much higher. So here also you see that the volumes are very high, the prices have gone up, and had you entered the market at this point in time, somewhere at this point in time, you would have made a profit because the prices have gone up. And over here, if you see, there is a doji over here, which is what you can see. And the moment you see a doji, okay, sort of, you know, then you see that a reversal is definitely going to follow. Okay, and this is what you are seeing over here. The reversal is about to follow. Here, if you see again, the volumes have again overshot. And as the volumes are overshooted, it has to be taken in context with the prices. And if you see that in this case, though the volumes have gone up, but the prices are coming down. And you see that over here, the prices, they are coming down. Okay, so it is at this point in time that had you entered the market at this point in time with the prices going up, the volumes going very very up, prices however it's sort of going up as compared to the previous candlesticks, then from there on you see that the overall trend is again positive, giving you rich profits. So whenever you are looking at the prices, you also have to look at the volumes. So if the volumes are up, the prices are also up. It indicates a uptrend. Whereas there can be situations where the volumes are very high, but the prices are moving low, which means that there may be a negative trend which might set in. So volume as an indicator is very, very precious for you to take your entry level point or your exit level point. So volumes high, and as you can see, volumes very high and the prices coming down significantly, it's better to exit the market. And if the volumes are very high, coupled with a very high prices, better to enter the market. So with this, we come to an end of our market indicators. We have taken several indicators, and you can use the indicators for your decision making. But a word of caution that whenever you decide, you should not take one single indicator, but you should be taking at least 2 to 3 indicators to confirm your decision, and accordingly you should be taking it. So I hope you have gained a lot from today's session. Thank you.